the most sensible thing to do is to get a sort of global index fund. But the trouble is that the US is very inflated. It's now more than, I don't know where it is.
65%.
Yeah, you see it. Yeah, I was going to say 58%. So
it depends on which way you're looking, but yeah. I think.
And the currency shifts in the currency. It's large. And so you're buying, given that NVIDIA was around 6%, so when you buy a global index fund, you're actually putting 3% into an AI chip maker.
And £5 goes into Microsoft, I think, every time.
And so it's very, very... So the US market is very expensive. And it hasn't come down. I mean, it came down a bit. It came down bear market 22 and then bounced back with this sort of AI bubble. And
you said that very cool. You're like AI bubble in bold.
We're not going to talk about it at length. And then we measure the valuation stock market by looking at its price to earnings ratio, but we average the earnings over 10 years to get a sort of more reliable data. And it looks expensive. The US market's more expensive than 1929.
They've looked expensive for a long time.
It has looked, and it's part because of the super profitability of the likes of Google and Microsoft and so forth. And this never seen before.
So is it expensive then if they're backing it up with the revenue or the cash flows? If they're, people are like, oh, it's expensive, the PE, blah, 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 but actually these guys are making cash.
Again, this is this is a longer conversation. There are a number of things. The big tech is now having to splurge a lot of money on AI. So whether it typically, during bubbles, that even if the bubble is in a technology that eventually works, typically the spending during the bubble phase is loss making. Those companies are also under pressure from
monopolies.
For monopolies and breaking. I think that you get to a certain point where monopolies become sort of onerous to the public, and you say, hang on, so why is likes of Google and Facebook and so on allowed to buy up? With Facebook, you've got schools banning social media, you've got Google being threatened with a breakup in the US, you've got Apple being under the cosh with the EU. So people are quite complacent about the sort of big tech, given that it's had such a good run. But then also you've got higher rates, and that higher rates should feed through to make them
any day now.
When the bubble bursts, their stocks will come down.
Yeah, but there's always been these high periods of concentration within the indexes.
No. They again high
General Motors was a bigger share.
So make it clear to your listener what we mean by concentration. High concentration means that more and more of the stock market is in a limited number of names, like 50 names, for instance. We had something called the Nifty 50 bubble in 1972-3. Then it was 50 stocks that dominated market. Then in the late 1990s, during the tech bubble, that was again limited. I don't know, let's say around 50. It wasn't quite as strong as the Nifty 50 bubble, but very, very concentrated market. So you see, as the stock prices go higher and higher, the concentration of the market becomes more and more extreme. And then this year, we had, the so-called Magnificent Seven, seven stocks, large capitalization stocks, more and more concentrated. So if you go down to sort of concentration of market in 5 stocks, it's far more concentrated than ever before, and that is undoubtedly risky. What you can do to mitigate that is, instead of buying a market cap weighted,
equally weighted,
you could buy an equally weighted one. So you get sort of, instead of putting 3 or 6% of your money into NVIDIA, you're just getting a small, and that picks up the value. Compared, equally weighted indexes are weighted towards value.
But you're not backing the runners, right? Like, you know, you would have, if you'd have done that over I don't know what the returns are, to be fair. I think we looked at equally weighted and they did okay.
So the trouble with whatever works in investment is most likely to be what hasn't worked over the last 10 or 20 years. The winners are always shifting, and that's what actually makes investment quite interesting.
So just buy the index and forget about it.
Well, no, I'm not saying. I'm saying I actually think that I think the index, a broad market cap weighted index is a riskier proposition than it was 10 or 15 years ago.
Do you think there was other periods, say, where they were concentrated, they were risky? And when you talk risk, you mean potentially a bubble bursting imminently?
Valuation of loss of value. Yeah. No, I'm thinking of it just, more prosaically, just of low expected returns going forward.
Lower expected returns.
What people don't always get their head around is that the higher valuation of an asset, everything else being equal, the lower return you're going to get from that asset. And I mean, that's clearly true, say, with the bond. Yeah? It's not necessarily so true of these tech companies with fast growth and monopoly positions. But by and large, it holds true.
That was a clip from our full-length interview with Edward Chancellor about the impact of ultra-low interest rates. You can watch the full episode right here.